When standard corporate financial systems are subjected to the intense, multidimensional pressures of commercial real estate, they eventually fracture. Highly competent accounting teams regularly assume that standard corporate accounting principles can easily scale to manage real estate portfolios. The math is the same, so the workflow should follow. That assumption collapses against three distinct pressures specific to the asset class: severe capital risk, strict investor reporting deadlines, and profound multi-entity complexity. A standard enterprise resource planning system processes financial data sequentially. This animation shows a traditional corporate ledger. Simple transactions move left to right along a flat, two-dimensional plane. This linear model records transactions as isolated historical events, answering what happened and when. Real estate data rejects this flat model. The horizontal line morphs into a three-dimensional vertical hierarchy, revealing the true structure of a real estate portfolio. Financial data maps directly onto the asset's dynamic lifecycle, bypassing sequential order as cash moves across simultaneous ownership layers. Attempting to force a three-dimensional asset lifecycle through a one-dimensional sequential ledger creates a structural misalignment that generic ERPs cannot reconcile. We can trace this failure from the ground floor up. This blueprint represents the baseline operations of a single, isolated commercial property. In this diagram, we isolate the foundational unit of real estate accounting, the Single Property Limited Liability Company, or LLC. The inputs and outputs represent standard accounts payable and receivable. At this localized level, generic accounting software processes the cycles cleanly. However, investment properties rarely exist in isolation. They are bundled together into larger portfolios. To manage capital investment across those portfolios, an overlying ownership hierarchy is established. The single LLCs report to joint ventures, which in turn roll up into master funds. Watch what happens when a routine AP cycle attempts to cross these boundaries. A data packet starts at the LLC, hits a structural barrier at the JV, and fragments before it can ever reach the fund. Paying a simple bill at the property level now triggers a complex math equation. Those costs must be allocated correctly across distinct legal entities and highly specific ownership splits. Generic ERPs lack native multi-entity awareness, forcing controllers to bridge the gaps between layers using high-volume manual journal entries. As ownership structures stratify, routine AP and AR cycles mutate into complex cross-entity reconciliation workloads that drain specialized accounting resources. That multi-entity structure creates friction at the top. But at the property level, another breakdown is happening, driven by raw data volume. The complexity of the structural hierarchy is multiplied by extreme operational variability happening within individual assets. Zooming back into the single LLC node, we introduce the massive influx of property-level variables. The system must process dense lease terms alongside high-volume vendor invoices. The critical accounting engine tasked with sorting this erratic influx is the Common Area Maintenance, or CAM, reconciliation. A CAM reconciliation requires cross-referencing generic, uniform vendor expenses against highly specific, dynamically changing rules buried deep within individual lease abstracts. Here is the breaking point. The system attempts to process these dynamic, abstracted rules, fails to compute them, and immediately stalls out. Generic ledgers simply cannot automate logic derived from non-standardized commercial lease abstractions. To complete reconciliations, accounting teams must extract operational data entirely outside of their core ERP system and drop it into vulnerable, highly manual spreadsheets. When the core accounting system cannot natively read the operational rules of the asset, manual bottlenecks are inevitable, compromising the reliability of the firm's data pipeline. As data reliability drops, another pressure source compresses the workflow, the overarching constraint of time against complex financial obligations. Real estate portfolios are governed by an inescapable multiplier: strict, immovable investor reporting deadlines. These external capital deadlines clash directly with the internal operational bottlenecks stalling out the property level. Returning to the complete multi-entity map, we can observe exactly how time impacts the flow of this financial data. The manual CAM reconciliations taking place in spreadsheets severely delay the financial close at the base LLC level, preventing accurate data from moving upward. That delay cascades. The timeline bar hits the critical top layer exactly as the investor deadline arrives, but the fund node remains entirely empty. To close the books in time, accounting teams rapidly rush the manual data aggregation across the joint ventures and funds. This forced, disjointed data aggregation creates a severe consequence at the highest level of the portfolio: macro-level audit and regulatory exposure. Isolated operational inefficiencies at the property level compound upward. Under the pressure of hard deadlines, they evolve into systemic capital risk. Rebuilding the integrity of the data requires true architectural integration. Solving systemic real estate complexity means abandoning generic software patches and migrating to an entirely purpose-built system architecture. This diagram illustrates a tailored workflow model. Rather than fragmenting the logic across manual spreadsheets, this architecture relies on a central, unified data spine. The first capability required for growth is true multi-entity visibility. A single system of record natively maps and connects all joint ventures, funds, and LLCs without the need for manual journal entries. Second, the architecture integrates structured workflows directly tied to the asset lifecycle. CAM reconciliations and lease abstractions are processed natively inside the system, removing the bottlenecks entirely. The data flows up the architecture, automatically triggering the final deliverable precisely on time. This automated, systemic reporting effectively neutralizes the audit and regulatory exposure, providing structural protection to the firm's capital. High-growth firms utilize tailored accounting systems to drive competitive advantages, moving beyond the limitations of standard administrative overhead. The real estate ledger serves as a structural map of capital risk. Navigating that map requires a system engineered specifically for its three-dimensional geometry.